And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of GTR Africa 2025. Absa is a registered FSP. Your story matters. Good evening. Welcome to The Money Show tonight. I'm Stephen Grootes on a day which is probably going to be remembered. I don't know. Do you watch popcorn as this tariff war explodes between Canada and the United States? I mean, are we sort of choosing between salt and butter flavored at this point, or are we quivering in terror because we know what happens between two economies of that size will eventually have an impact on us? So Ontario, the premier there, big state in Canada, they imposed a 25% tax on electricity sales to the United States. It's hydroelectricity, as I understand it. In response, the US President Donald Trump then imposed and doubled the tariffs he's planning to impose on Canada as a whole on steel and aluminium, and repeated his comment that he wants Canada to be the 51st state of the United States. Canada is unlikely to respond favorably to that. I don't know that many Canadians. I'm feeling very well disposed to them at the moment. But you do get a sense that they're unlikely to say, yes, we want to be part of the United States, especially at the moment. It is extraordinary what's happening in the US. And of course, the impact will be felt. And we're seeing US markets dropping very strongly yesterday. And some of that movement still heading down today. We'll keep a very close eye on that story as it develops over the next couple of hours. Here at home, we'll speak to the Absa Interim CEO in just a moment. But in a story on Business Live I thought was very interesting. Jason Quinn, you heard him on the Money Show last week. He's the CEO at Nedbank. He gave up 60 million rand when he left Absa. There was a sort of retention agreement. He gave that up to go to Nedbank. Now, look, he was getting promoted. Is to a slightly smaller bank, but still, you want to be a CEO of a Big Four bank. You take the opportunity because you don't know when another one is coming. But still, I found that to be a very interesting story. And then, if I may, Attacq, we'll hear from their CEO in a while. They're the property company. They're now proposing, and they're going to, by hopefully the beginning of next year, they say, have a water backup system in all of their commercial properties. So if you're renting a shop or something from Attacq, you will have backup water supply for 2 to 5 days. Now, just think for a moment of what that costs. Think how big the tanks have to be. Think about collecting the water, all of that. Imagine it'll be a sort of buffer system from the municipal system. Just it's a backup. And just think for a moment about what you could be spending that money on. It is astonishing that we are where we are. And I'm speaking several days after the President, Cyril Ramaphosa, was in Johannesburg talking about how surprised he was, how unpleased he was by the state of it. Sorry, sir, but I seem to recall that you actually live here. And talking, was it a proposal, or are you definitely going to have a presidential working group on Johannesburg? Still not seeing anything for it, I'm afraid. A few posters saying G20 proud host, Johannesburg proud host of the G20. I know Cape Town's made an offer to host it. Well, I suppose we'll see how that plays out. But I think what Attacq is telling you through its actions is that it doesn't believe that water problems in some of the big centres are going to get sorted out. And that really tells you so much about the situation in council, so many of the councils in Gauteng in particular, but in large parts of South Africa at the moment. 011 883 0702 021 446 0567. Good to hear from you. Voice notes this evening on 072 702 1702. We'll update you on the situation regarding the deeds office. We had that call from Julian last week about that. There is progress. Does look like it's going to be moved. Your experience, if you're a worker in that office, by the way, with a lift that doesn't work, you've got to get to the 22nd floor. There are problems in government buildings, we know. If you are facing some of those problems, it'd be good to hear from you on The Money Show tonight.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, Absa is saying one of the reasons it's been able to increase its headline earnings by 10% in the 12 months to the end of December is that its research shows customers believe they're getting a better experience from the bank. Revenue was up by 5%, non-interest revenue up by 6%. The interim CEO at the Absa Group is Charles Russon. Charles, good evening to you. Good to talk to you again on The Money Show. You say you've been able to improve your risk management practices. How important has this been in the improved performance we've seen from Absa?
Hi, good evening, Stephen, and good evening to your listeners. Basically what we told investors at the beginning of December when we did our market update at that stage was essentially that we were in a recovery phase. We needed to rebuild trust. It was about execution. It was about precise execution, both in the immediate, the short term, and the medium term, in order to rebuild this trust. And a big part of that was, we'd taken actions to ultimately deal with some of our impairments. We'd seen impairments growing, and we're outside of our through the cycle guidance range. And, we took decisive action at that point in time, and ultimately that started to flow through a few months later. So, it certainly is pleasing, and it's certainly the first step in starting to rebuild some of this trust with our stakeholders.
It does seem some of your customers are in slightly better financial health. Interest rates are slightly lower. Load shedding is almost gone. The fact they're in better health financially, is that helping too?
Yes, for sure. So, some of the stuff is what we did, and some of it is the external environment. So certainly the rate cutting environment, I think, has helped starting in September. You had the two-pot system, maybe some of that money has flowed in some way. And then I think some positive sentiment has ultimately come through off the back of the election and, how quickly we got to a government of national unity. So I think that has helped. And it certainly is part of the story. But
Charles Russon, are you still with us? Not quite sure what's happened on that line there. We just want to continue the conversation with the interim CEO of Absa. An important conversation, of course. Questions to ask about how the system is working, what differences they are making. All right, Charles Russon back with us now. Sorry about that. Charles, a big part of this is the customer experience. Banking is very competitive, often about the digital experience. You say your customers are happier. What have you changed?
Yeah, you're spot on. So ultimately, it's all about your clients and your customers. So, we've got a few key measures. One, we want to grow, and we want to grow our customer base. So we want more active customers as we go forward. And we measure that, and it was pleasing to see growth on that front. The other is the client and the customer experience surveys, where we get run by independent organizations, and that brings back the feedback as to how they've received us. And certainly we want to always see improvement there, and we know we can always improve. And then the final one is around customer and client primacy. In other words, do they do most of their business with us? And that's the other one. We saw improvement this year. So, look, what is the big change? It's one of the key elements that we spoke about at the beginning of December, and that was we've been very product-focused as an organization, but to ultimately start to bring in, the client-customer side of it. So measuring, understanding the customer and client profitability, and how is that happening? Are we focused on it? Are we putting the customer at the center of what we do? Now, everyone says it, and, I'm not going to claim that we've won in that space, but, you've got to start, and you've got to start to drive that journey if you ultimately want your customers to believe in you and believe in your service and what you're about, and staying with them through thick and thin as well.
So, you do have to stay through them. I would agree with you, but the main point, the contact point is the app. It has to be simple. It has to work. You have to be able to access a broad range of services. It also, I imagine, has to direct you to more services that you can then charge for. Is your app competitive against the offerings from other banks? And, Charles, other banks that will be coming online this year. There'll be more banks with more apps. Some of them might be newer than yours because they're only starting now. It's an incredibly competitive space, and the point of competition is the app.
Yeah, you're spot on. I think it is the app, but it's also the service that they receive through the different channels. So whether it be the branch, whether it be into your call centers, etc. So I think it is the collective as we look across all of that. So, yeah, in terms of all the surveys that get done by the different bodies, and, we can name some of them, but it's, the feedback is that we are very competitive. But at the heart of it has to be putting the customer first in this equation. It can't be purely about profitability and trying to drive an outcome where you seek to get every opportunity to take fees off your customer. long-term longevity of your customer and loyalty of your customer has to be absolutely paramount through all of this.
In your outlook, you say next year you'll achieve a return on equity of 16, and that's next year. Other banks seem to be way ahead of you. I mean, First Rand last week, their ROE is over 20. Isn't there a risk you might fall a bit further behind?
Yeah, I mean, Stephen, that's why I kind of refer to it as a recovery phase, and that's what we put out there. We acknowledged it back in early December. And first of all, we had to commit to what we'd previously promised, which was, we were going to hit 16% in 2026 as an ROE. We believe that starts to put us in the game. By doing that, you are generating capital for the organization. It ultimately means that you are delivering on what you promised. Yeah, what the others do, I can't say. But we are very focused on just making sure in the immediate, the short term and the medium term, we actually do and deliver exactly what we say, and we really get that ROE back to a position where we are delivering returns well above our cost of equity to our shareholders.
And Charles, I apologise for having to ask a question that could affect you directly, but the board does have to appoint a new CEO at some point. You're interim CEO now. You may be in the running. Is there any timetable on that?
Yeah, look, obviously the board is running their process. I don't run it, and I'm not party to the decisioning, as you rightly said. I think the urgency of the situation is certainly not lost on them, but at the same time, we are a systemic organisation, not only in South Africa, but right across the continent. We've got 40,000 employees. They need to run a process that has the right due diligence around it, and ultimately comes to the right outcome that they can defend and they can stand behind, given the enormity of this organisation.
Charles Russon, thank you very much indeed, the interim CEO at the Absa Group.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, in about 20 hours' time, we should see the Finance Minister, Enoch Godongwana, delivering his budget. His previous attempt, of course, was aborted, essentially because the DA said in a cabinet meeting 2 hours before it would oppose the 2 percentage point VAT increase. Contradictory reports over the last few days over whether an agreement has been reached for a budget tomorrow. Certainly, it seemed over the weekend that DA was not fully supporting a budget that would include a VAT increase. Razia Khan is the Managing Director and Chief Economist for Africa and Middle East Global Research at Standard Chartered Bank. Razia, good evening to you. Good to talk to you again on The Money Show. Still some uncertainty around all of this. We've seen the draft of the previous budget, of course. Is it really possible to make any predictions about what's going to happen tomorrow?
Well, I think we've got some broad outlines. The fact that there is seen to be a need to stabilise debt levels suggests that there probably have to be revenue measures of some nature. Now, we know that there has been significant political debate around whether the country is ready for any kind of VAT increase. And the market is probably thinking a compromise at this point. It's been very difficult to judge on the basis of media reports so far, as you say, but some combination of expenditure cuts, the pledge for greater efficiency, plus at least a compromise on a VAT hike.
So, I mean, it would seem then a smart idea to have some bet, a suggestion that there will be a VAT increase of some kind. I suppose without it, it's very difficult to make up for the lost revenue.
That is the precise issue. If you look at where South Africa stands right now, and this is laid out very clearly by Treasury earlier, that there is a need to do things more rapidly in order to stabilise debt levels. It's clear to everyone that a more reformist Treasury is set on regaining South Africa's investment grade rating, and this is going to require steps of a more significant nature in order to stabilize debt. Now, there's the ongoing pledge to achieve what economists call a primary fiscal surplus over time to try to stabilize debt levels. This means that if we strip out interest costs, South Africa has to receive more in revenue than it's going to be able to spend or that it wants to spend. And that's been the case for some time. But markets hadn't wholly rewarded the South African Treasury for that pledge to have this fiscal stability anchor in place, if you like. Something more meaningful is needed. Something is needed to accelerate this process. And even more so when we consider just how weak South Africa's economic growth was. It would have struck a lot of people reading through the draft budget that might have been delivered on the 19th of February that even then Treasury was forecasting a growth rate of around, or estimating a growth rate of around 0.8% for 2024. And the actual outcome was even lower than that. So GDP growth, normal activity on its own, is probably not going to deliver the rapid improvement that is very much needed. There's also a need to spend a great deal more on infrastructure. How do you get the growth? And for this reason, we think Treasury will still be looking at its revenue options.
I don't know at this point, as I talk to you now, Razia, if all of the coalition partners have agreed. If they don't have an agreement, if there's no budget speech tomorrow, I mean, the message that would send, I don't even want to think about.
That would be very, very damaging to market sentiment. It would be very damaging to perceptions of South Africa. And the hope is that that isn't going to be the case, that after that almost budget on February the 19th, that the budget will now be read and some sort of compromise agreement has been secured. Of course, if there is outright opposition to any sort of VAT increase, and there really isn't a choice for South Africa's National Treasury but to pursue some sort of tax increase, then perhaps we see the opposition to the move coming out when it comes to voting on the budget. That's a wait-and-see situation. But for the moment, if you look at price action in South African markets, how debt auctions have been received, how the rand is faring despite everything going on in the world, there does seem to be this belief amongst investors that South Africa will do enough to try to stabilize its fiscal outlook. And that probably means some kind of meaningful revenue measure.
Razia Khan, thank you very much indeed. Managing Director, Chief Economist for Africa and Middle East Global Research at Standard Chartered Bank.
The markets.
Ryan Hills, Head of Fundamental Sales at Absa CIB. Ryan, good evening. Thanks very much indeed for coming in. Platinum shares, I mean, the platinum price hasn't jumped, but platinum shares are going berserk. I know the World Platinum Council said on Friday that there is a global deficit of platinum. You're suggesting something's happening in rhodium markets at the moment.
Yeah, evening, Stephen. It is an interesting space at the moment. It does seem as though there are probably two stories on the go there. One is that there is some speculation that we might see some mines shut down in South Africa, possibly because of what appears to be, for the foreigners anyway, an escalation as far as load shedding is concerned. And so that would tighten PGM markets in general. Of course, as you say, we haven't seen that in the platinum and palladium price yet. Rhodium's an interesting one. It's an extremely difficult market to forecast, very thin liquidity, and we've seen some significant dislocations in the past when even small amounts of moves happened on the demand-supply front. What appears to be happening at the moment is there's a rumor that there's a contract that needs to be settled. There's a shortage of metal in the market. There's an aggressive buy out there. This metal price is up something like 30% since the start of the year. It seems like it could be fairly short-lived. And that's the big risk. So rhodium basically moving up much higher seems to be dragging the PGM stocks ahead with it. But time will tell whether this is something more fundamental that's occurring or whether, in fact, we'll see the dislocation to the south, which is, I think, the view that is ours.
Sasol had a strong day at the start of the day, came down a little bit, down to 2%. I mean, all of last week it was sort of heading one way, heading down. This week it was heading up. There's a very big pendulum when it comes to Sasol at the moment.
Absolutely. And again, I think there's a general sense out there that the stock's looking cheap, depending on the measure that you use to evaluate it on. Certainly, our view is that a price-earnings multiple is not the right way to be looking at it, even though, there are some views out there that suggest that should be the approach. We prefer to think about cash flows and price-to-cash flow ratios. And on that basis, it doesn't look particularly cheap versus its offshore peers. But I do think that what's happening at the moment is simply any positive news coming through that supports the oil price seems to be dragging Sasol up as well. And I think we're basically just going to have to watch the Rand oil price from here on out. And presumably, again, I think the generic view out there, the consensus view at the moment is that oil prices will probably continue to be softer. There's no lack of supply. There's no lack of capacity. And we could be in a situation where we're seeing slower global growth, partly because of the whole tariff debacle that's going on globally at the moment. And that could potentially drag oil prices further south. But have to watch the oil price in Rand terms.
Absa's earnings up 10%. Their headline, their earnings were up 10%. Yes, the headline earnings were up 10%. Their sort of share price jumped at the release of their results. You heard your boss's boss's boss on the radio a few moments ago. What was the market saying? I mean, it kind of fell back quite strongly, flat on the day, really.
I think two issues at play there potentially. One is, and certainly, as you say, well received initially. I do think the market's looking for some clarity with respect to a permanent leadership appointment. Clearly, markets don't enjoy situations where there's some flux with respect to, or uncertainty with respect to the C-suite. So I do think if that gets landed well, then the market will presumably take that as a positive. But I do think at the same time also you've had the other banks get caught up in a bit of a sell-off, possibly some profit-taking, and I think that Absa was simply a casualty of that move as well.
US markets, I must ask. I mean, the Nasdaq was down 4% yesterday. The Dow Jones started down very strongly today. And obviously, this is all about Trump and tariffs, Ontario imposing electricity taxes on the electricity sold to the US. Trump responding. The Dow Jones down, the figure I have is down 1.4. Nasdaq at the moment down 0.4. The S&P 500 down 0.84. Are we going to watch this all week?
I think we are. I think that possibly what's happening is we potentially seeing Trump starting to reflect some concerns about the levels of debt in the US and starting to say, how can we possibly recoup some of the trade benefits that we're seeing with offshore partners, and tariffs is one way to do that potentially. But we're also starting to see the emergence of that horrible S word, stagflation, where you've essentially got slowing GDP growth at the same time as you've got higher inflation. There are no easy remedies. You certainly can't cut your way out of that in terms of Fed rates. And so we could be in for a very volatile time, I do think.
Sure. Ryan Hill, thank you very much indeed. Head of Fundamental Sales at Absa CIB. Bringing the time on The Money Show to 6:30.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
Well, we'll find out more about what's happening at the Deeds office in Joburg in a moment. But if you of your business have been affected by that, be good to hear from you tonight on 011 883 0702 and 021 446 0567. I know architects, for example, who have to go to certain offices at certain times because things aren't open in the same way that they used to be. You can imagine the impact that this has on business. You can also, of course, send us a voice note on 072 702 1702. But issues around government buildings and how they affect your business would be very interested to hear from you on that, please.
The Money Show
with Stephen Grootes.
The property group Attacq announcing very strong results today. Its distributable income per share up by just under 50%. Obviously, that means a higher interim dividend as well. The group's saying some of the reasons for this, it's been able to increase its trading density significantly in some of its malls. It's producing more of its own electricity. Big plans for water backup facilities as well. Jackie van Niekerk is the CEO at Attacq. Jackie, good evening. Thanks for your time on The Money Show. We've seen so many people claiming that online retailing is taking over from the shopping mall, that shopping malls are the past, not the future. You seem to be attracting more people to your malls.
Yeah, good evening. Thanks for having us. It's a mixed bag. It's definitely stats we're monitoring very closely via different data platforms. Convenience shopping, we definitely see that, buying dog food is really not glamorous, so people are buying that online. So we continuously need to provide the shopper with a reason come back into the mall. We've seen great success with micro retailers and local retailers actually migrating from online to bricks and mortar. It's all about, the experience we provide, the entertainment value you provide to your shoppers, and also under one roof, what can they actually shop, under one roof. So, dog food is out and dining is in. So we definitely need to keep track with what's happening with our consumer.
You've moved quite aggressively into generating as much of your own electricity as you can. That would obviously be a big upfront investment. Is that making your mall slightly cheaper to run, especially as electricity prices from councils and Eskom get more expensive?
Definitely. I would say that's probably our best capital allocator for our business at this stage. We're getting tremendous, great IRRs on the investment of solar power. And we also, finding mechanisms to feed the solar power, via the generator. So also it throttles our generator usage when we do have load shedding. So it's a cumulative effect that the solar power is providing us. And we definitely seen a vast improvement in our net operating income and also our utility consumptions because of the solar power installations.
You say you're going to make sure all of your commercial properties have backup water supplies that'll last for 2 to 5 days. This will be by next year, and obviously I understand why you're doing that. But that must come at a cost. I mean, that's quite a lot of facility, big tanks you'll have to install, money you could have spent on something else.
Absolutely. We've always had the view of when we built our buildings, we have to have 48-hour backup. We know at certain of the buildings increasing it to 5-day backup, especially our retail, larger retail format shopping centres. Business continuity is key. Our clients will pay more for, rental. Our shoppers would come to our shopping centres if they know it's uninterrupted. So yes, rands and cents, it looks like a big investment, but from a sustainability and business continuity, it's an incredibly valuable investment to make in our shopping centres and in our commercial real estate.
Are you doing this in all parts of the country that you operate, even in areas where they maybe have quite stable water supplies?
You'll be surprised if you've got to consider what is stable or not in certain areas of the country. We can say in George, where we've got a regional shopping centre, over December when we all flock down from Gauteng to that egg part of the world, we definitely see drops in our pressure coming from council. So we luckily had the water backup during last December, so we could, provide great pressure water and consistent water even in areas where it's more stable.
You're planning to invest more money into the waterfall development in Gauteng. It's nearly 3 billion rand. I mean, my first thought was I'm glad to see optimism in the Gauteng property market. You're confident there's demand for that kind of project?
Oh, absolutely, yes. Most of these projects are client-led developments. We've got quite a rigorous vetting process for our clients, so most of it is client-led developments. We've also, for the last 6 months, had incredible inquiries from multinationals, blue-chip clients wanting logistics space and also commercial real estate space. So we've definitely seen a surge of people coming back to the office. There's no more work off Teams and in your pajamas, and people are coming back to the office, and that requires more office space.
And that's happening in Gauteng. I mean, so much sort of middle-class dinner table talk about people moving to Cape Town. You can see that in house prices in Cape Town. We know in Gauteng, house prices have stayed largely the same for a decade. You're seeing more demand in Gauteng for offices that will require workers.
Absolutely. In the last 6 months, we've signed the likes of Bayer Pharmaceuticals, Organon Pharmaceuticals, Nokia, Siemens Energy, Siemens Healthineers, Pragma, so many corporates. And corporates, certain of the corporates need to be in Gauteng. There's also limited supply in Cape Town. We think Cape Town is absolutely, a great city to operate in, but a lot of the corporates are established already in Johannesburg. And I think why Waterfall is a net benefactor at this stage is because the flight to quality, but also flight to resilience, business continuity, safety and security. And because we're a precinct developer, we look after all of those small details. And we've definitely seen an influx of inquiries and also new clients in the office market. Another evidence is the residential prices and also the residential sales at Ellipse. We've seen an incredible 6 months of sales, and it hasn't stopped.
Jackie van Niekerk, thank you very much indeed. CEO at Attacq. Good to hear some optimism about Gauteng property. Your experience of it, though, please, and also your experiences of trying to make sure that your home and your office are actually free of electricity and water supply problems. I mean, it's a big issue at the moment. It's a big issue in many parts of the country, but you see people spending a huge amount of money to take themselves off the grid any which way they can. More and more boreholes in residential areas. I mean, it's obvious. You can hear the drilling in some cases. And all of this really is simply because people can no longer trust government services. Your stories, please, on 011 883 0702 and 021 446 0567.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud sponsor of GTR Africa 2025.
Well, last week you heard from the attorney, Julian. He called in about the problems in the deeds office in Joburg. He told you the lifts were not working. As a result, people were unable to lodge deeds. The whole process was jamming to a halt. You can imagine the knock-on effect. Properties can't move. Businesses can't finish transactions. The amount of money that government is supposed to get through duties and taxes is not coming through. Everything just sort of stops. You can also imagine the problem workers face. I mean, would you walk up 6 to 8 to 22 flights of stairs just to go and lodge a document each time? All of this really gets to the situation facing government buildings. Well, some reports now that this deeds office is in fact going to move. Sibusiso Nzala is the Johannesburg provincial organizer for the Public Servants Association, a union representing workers in this space. Sibusiso, good evening. Thanks for your time on The Money Show. Have you been officially told that the deeds office is actually moving to another location?
So, good evening, Stephen, and listeners at large. Indeed, yes, after, lengthy discussions between the PSA and the management of deeds, we did reach a consensus whereby we have actually then agreed that indeed, the OHS issues that are in the building that is occupied by the employees of deeds at the moment is not in a good condition, and then it does not allow employees to actually be able to function in such a way that it threatens, their health and safety itself. So we reached an agreement to say that indeed the employees must be moved out in that building. And obviously, even the clients are of the same view that that building is not safe, to be occupied by the clients, the workers, and the employer itself. Okay.
So where's it going to move to, Sibusiso? I mean, is there a building that government owns? I don't know if it's the Department of Public Works and Infrastructure, or are they going to have to rent more space somewhere else?
Okay, look, according to the plan of Rural Land Reform, Department of Land Reform and Rural Development, there is a building that is actually planned for, that is on the plan for the employees to move in 2026 September. But due to the pressing OHS issues, then, the DG of this department was then forced to then begin a process of then involving public works to then look into issues of moving the employees into a temporary building. Meanwhile, they are waiting for their permanent building, which will be in 2026 itself. So indeed, the Department of Public Works actually confirmed that that process can take a maximum of 6 weeks. So now what is going to happen, a task team, which then comprises of management of deeds, organized labor, then to then run with the process and ensure that all parties are involved in the process so that employees cannot then find themselves, in a disadvantage whereby they will be moved into a building or maybe with existing, OHS issues itself.
So, okay. I mean, it's not just the workers who have to move. Won't there be documents, deeds that have to move, or is that done in a separate way?
Yeah, no, obviously, if the workers move, also the documents will have to be moved. And the employer has then promised to say that as soon as a new building is actually then secured, then what's going to happen is that the files will actually then be moved as well.
I mean, those files are incredibly valuable. Nothing must happen to those files. They're records of property ownership.
No, look, as organized labor and as PSA, we are saying, because of the OHS issues that are existing there, indeed, the employees must be moved to a safer building. The issues of the documents, being moved there and to ensure that they are in safe hands and they do move there securely, it's up to the employer itself. But I think, a lot of departments have been moving, like, for instance, eGov, which is also responsible to then, process a lot of confidential documents itself. But they have been able to move out of a building that is not actually in compliance with the OHS. And there's been no issues reported to say that they are lost files itself.
We live in a country where one union a while ago reported that sewage was coming out of the walls of a police station. I'm not making this up, Sibusiso. Do you find that many of the buildings in Joburg, where your members work for government, are in a similar state?
Look, Stephen, if I can tell you, I think maybe 95%, if not more than that, of the buildings that are actually utilized by our members in Johannesburg, they are not in a good condition. They are at a deteriorating, condition itself, in such a way that, sometimes we really do find ourselves, in head on with the employers, because it always looks as if, as unions, we don't want workers to then report to duty to their workplaces. But it's not because of that. We do want our employees to then serve, as per the obligation that they signed between them and the employer itself. But if the conditions are not really allowing and they are actually life-threatening, we cannot be in a position to then, allow our members to then risk their lives itself.
Sibusiso Nzala, thanks very much. Really do appreciate it. The provincial organizer in Johannesburg, the regional organizer for the Public Servants Association. Your stories of buildings you've been into, the government buildings, please be good to hear from you tonight. You at The Money Show? It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of GTR Africa 2025. Absa is a registered FSP. Your story matters. Good evening. Welcome to the second hour of The Money Show. We'll be talking personal finance with Warren Ingram in a few moments after 7:30. He suggests that, in fact, as you get older, you should not lose the sort of aggression when it comes to investing. In other words, you shouldn't just put all of your money in a sort of safe haven. You should do something more with it. We'll ask him why from 7:30. Looking forward to that conversation. Also, we'll talk about Transnet and ports. They've got a new tender out. It seems to be quite important. There's a lot going on around ports and Transnet. And don't forget, of course, already in the studio, we'll speak to Dr. Rotendo Hundwingwi about some of the business stories coming out of our continent. You do want to stay around for that, just to get an update on what is happening in different parts of our continent and how it can affect you. Keen to hear from you, your experiences of government offices at the moment when you try and do business. Are you an architect who has to get a plan passed? Are you someone who just needs a little bit of paper or a signature from someone so that you can go and do this? What's your experience of that like? Would be good to hear from you, please, on 0214460567 and 011-883-0702.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, confirmation yesterday that the Transnet National Ports Authority issuing a terminal tender to design, build and operate a multi-purpose terminal at the Maiden Wharf precinct in the Port of Durban. There's a lot going on around Durban. Pier 2 at Durban, the busiest section of our busiest port, has already started a privatization process, although two of the companies involved in that are still, of course, stuck in the courts having an argument about that. Warwick Lord is the chair of the Multimodal Inland Port Association. Warwick, good evening to you. I really appreciate the time. When Transnet issues a tender like this, and we know there's a lot going on around Durban, are you expecting a lot of interest? I mean, presumably this is a big opportunity for someone to design the thing, build the thing, and then operate the thing.
Good evening, Stephen, to you and your listeners. It's a pleasure having the opportunity to chat to you tonight. It is a massive opportunity, and it's part of the changing supply chain that's currently underway, whereby private sector is now able to play a more meaningful role in the entire supply chain of South Africa. And this latest pronouncement that we're discussing tonight is one in a series of events or announcements that has led us to the sort of changing supply chain that we currently have underway, and we're very excited, and Transnet must be commended on taking these bold steps in order to liberalise the supply chain.
I mean, this change is actually happening if you think about it. If you consider that for a very long time you did not mention the P word, the privatisation word. I mean, since COVID, things have moved very quickly.
I think so, Stephen. I think when you have a look at the way the status quo has happened and we're not getting the results that we are anticipating or hoping out of the current operations, we have to look at things differently. And I think the monopoly that Transnet has had over the entire rail port infrastructure has been part of the reason we are where we are. So we are very excited as MIPA to have the sort of liberalisation as we discussed, because it now enables all role players to fulfil a role as opposed to just the public sector.
Are there many companies in South Africa that have the capacity to do what's being asked? Or are you expecting, like we've seen with Pier 2, that we'll actually have outside interest maybe?
I think the size of the opportunity is big enough that it'll definitely attract outside interest. However, we definitely have a few large companies in the country, specifically Grootes, are operating the terminal, quite a few terminals, both in South Africa and Mozambique. And so as a South African company, they definitely have the ability to operate it, amongst a few others as well. But we do expect international interest to be quite high, as just discussing a few international colleagues earlier today, the expected volume increase is quite exciting, specifically considering we've sort of had the door closed for a while, and this hopefully will unlock the door and allow free flow of cargo to happen at a much greater rate.
I mean, how long does a terminal like this take to build? Are we looking at 5 years? Are we looking at 10? I realize it's a sort of port that already exists, so the kind of location is pretty specific. I don't know what it looks like now. I haven't been there, or not for many years, so I don't know, how easy it would be to design something like this for that. But I presume that obviously this is not going to happen tomorrow, but we would like it to happen sharpish.
I think the biggest issue, or the few facts, is the fact that it's only 2.5 hectares or 25,000 square meters. So it's not absolutely massive from a size perspective. However, it has a huge enabling role to be playing in here. So we do expect the sort of various players to come in and take up the opportunity. It will take a while to develop. However, logistics is a very low margin game. And so what you will find is certain portions of it will become operational as quickly as possible while the wider site gets developed into a fully fledged. That's sort of been our experience in order to at least keep the containers moving, or alternatively the product moving through the terminal, at the same time deploying capital. Unfortunately, supply chain and logistics don't wait for anyone, and often it's like trying to fix a train while it's moving.
So in other words, we could see the first part of it working maybe in 3 years, but the total part of it only working in 10.
Exactly. I think the most important component, however, though, is the build. And once the design has been agreed to and been built, that's a relatively quick process in comparison to what we have to go through now with regards to going out for an RFP, having the RFP awarded, those behind-the-scenes negotiations and contracting, which then finally leads us to an agreed-upon facility that's going to be built. And I think that process leading up to where we actually turn the first sort of soil is critically important. And we can see that in what's happened with a previous award for the Pier 2 terminal and the sort of current legislation or current legal action that's going against that. That doesn't help any of us, as what it does do is it brings uncertainty into the system. And what do companies do when there's uncertainty? They refrain from investing, and they have a wait-and-see approach. So unfortunately, unless we get this right at the get-go, we potentially have the problem of suffering the same sort of issues as the Pier 2 RFP had.
The last thing you want is court case after court case, and everybody appeals, and it does seem to go on forever. There is another issue to this, Warwick, and I almost want to whisper this too, but it specifically refers, the tender refers to, the specs refer to dry bulk agricultural products. Does that require, you would have to be sure as the bidder, if you're going to operate it, that there'll be enough demand for the services to pass through dry bulk agricultural products?
Well, 100%. So you'd have a look at the averages of what sort of materials have passed through or expected to pass through, and do your business case and your due diligence around that. It is a risky business, and for example, to use one of the sort of agricultural products, maize, 2 years ago, we were exporting maize. The facilities were full. And over the last year and a half, there's been zero exports of maize, and we've even imported a little bit. So there is that difficulty in forecasting. However, because you're a facility that's handling both import and export, if there's an imbalance with the required more, let's say, agricultural product required in South Africa, well, then they'll flip over to an importing facility. And when we have great maize harvest and good maize prices, we can export, and then they'll flip over to an exporting facility. So I suppose that does cover some of the risks in guesstimating what volumes there are. But the guys get quite good at this.
The last time I designed a port, I was about 6 years old and I was in the bath. And I remember very distinctly the red Lego ship that I had, and my brother had a black one. His was the police one, so obviously it was better. But when you talk about a dry bulk agricultural product pier, so it's specifically around that, how different is the design of that to the design of a normal bog standard kind of cargo pier that Transnet already has?
So I suppose what we have to do is differentiate, because you've got the island view, which is all the petroleum and liquid-based products. You then got, so the Richards Bay, which is a coal terminal, and mainly Durban, which is container terminals. So each of these have various different flavors or different aspects and requirements. What we have found is that the most generic is the container. Obviously, that's a standard unit across. However, they do require specialized equipment in certain formats. So, for example, you'd use conveyor belts with the coal into Richards Bay in order to get that onto the vessel. And the same can happen with maize on this side. So it's very much product specific. However, these multi-purpose terminals have to have a large amount of capacity and latent dormancy almost in order to handle whatever gets thrown its way, as it's not just handling one specific item.
In a perfect world, I mean, you would like a situation where the goods arrive by train. I presume that already happens at Pier 2. You would have to take that into account with the design as well. Yes, you can do it by truck if you want to, but you really don't. You want to use trains, I imagine.
100%. I think the poor cousin in this whole discussion around supply chain has been train operations. The fact that it hasn't fulfilled its natural or it's what its strategic strong points are in our supply chain has led to the congestion, the overcrowding of roads, the potholes, etc., and then a lot of the deaths we see on the road is because we are not utilizing all avenues at our disposal, all supply chain avenues at our disposal. So I think it's absolutely critical that rail does get brought in. I also believe that rail has the opportunity, or part of its strength is that it can move, significant volumes over significant distances and with significant weight. So we have to really start bringing this to bear. And specifically when you talk about an agricultural multi-product terminal, you're talking about bulk here. Significant amounts of whichever product you're bringing in, and ideally you'd like to bring it in rail.
I mean,
on this,
No, go on.
On this, we're actually discussing at the moment with one of our clients, Maersk, in the area, in the Cater Ridge inland port, that we are looking to address the citrus season coming in at the moment. So a lot of citrus needs to be in refrigerated containers or reefers at the moment. And that sort of leg down into the port from the cold storerooms is a very interesting supply chain solution, because what we need to do is we have to keep the temperature static and stable the whole time. As soon as we go outside of a certain band, that container is no longer valuable, which is part of this rail operations we're bringing to bear.
Warwick Lord, I really appreciate the time. It's fascinating. Thank you very much indeed. Chair of the Multimodal Inland Port Association. And just to clarify, while my brother did have the better boat, my train set was faster.
The Money Show.
The Africa Business Report.
Dr. Rotendo Ndingwi, Founding Director at Tribe Africa Advisory, author of Rumble in the Jungle Reloaded. Rotendo, good to see you. Thanks so much for coming in. In a way, this reminds me of the pandemic. More collaborations needed to make sure that we can produce a vaccine industry that goes from 1% to 60% of the vaccines that are used in our continent.
Yeah, it's a big thing. And a good evening to you, Stephen, and to your listeners. So Africa at the moment, which is actually quite sad, at the moment we only produce less than 1% of the vaccines that we actually consume on the continent. So there's a big vision it's called the Coalition for Epidemic Preparedness Innovation. So it does sound like a vaccine. It's a very long name. But basically, they are the arm of the Africa Center for Disease Control. And they've done a report. And they've said by 2040, we've got the capacity to actually manufacture up to 60% of the vaccines that we actually consume. Now, that's a good thing. I think the challenge with vaccines is threefold. And firstly, bearing in mind that even before I unpack those three things, which are quite key, is that vaccines, by their very nature, have got to work in the cold chain. So you can't just manufacture it. It's how you distribute it. It's how you maintain the quality, the expiry dates, etc., etc. So it's actually quite complex. So they've realized that in order to effectively distribute and manufacture vaccines, they need to make sure there's an adequate demand pooling. So there's a procurement system that's centralized. There are about 25 companies that have come together into Africa to actually coordinate around that. The second thing is obviously the distribution centers. And distribution centers with the right facilities of air conditioning, of refrigeration, etc., etc. And if you think about Mpox, you think about COVID, you think about Ebola, that all comes into play. And then the last component, Stephen, is localized manufacturing input, which just talks in terms of there has to be money to be able to sustain this. So this report outlines those three components. There's concerted effort by governments to actually get this off the ground. We know that from a South Africa perspective, I think we've got one or two parties that have contributed to that. But there's a big opportunity. Mozambique has also got a company. Uganda has also got a company. So there's a nice pan-African focus in terms of doing that. The reality is implementation.
And the issue is also around economics. There's a reason why the Serum Institute of India produces most vaccines for most people. Antiretroviral drugs have been around for a long time.
Yeah.
There are two factories that produce the active ingredients. They were going to merge until the UN asked them not to.
Yeah.
You know, there's an economics to it.
The economies of scale, and that's the challenge that is there. That's why it's easier said than done. Look, from a health perspective, one big dilemma that Africa has is obviously we've probably got the biggest health burden in the world.
Yeah.
And if you look at, I think World Health says that the average ratio of doctor to patient should be 1:1,000. In Africa, at 1:10,000. So there's a huge discrepancy. Then throw on that into that mix with the fact that we don't have adequate vaccines. When a pandemic does run wild, there's a challenge there. So definitely opportunity for private and public organizations to come together and provide a solution, because long term we can actually have a tangible impact from a social impact perspective.
There's been a lot of talk about the United States and the president there, Donald Trump, wanting a sort of rare earths deal in Ukraine. They're also in talks in the DRC over minerals, and the DRC is suggesting that there should be a minerals for security deal.
Yeah. So if you recall, obviously at the peak of the past 2 weeks, the discussions the arguments between the DRC, M23, and that whole saga, South Africa was also involved to a certain extent. The DRC, President Tshisekedi has gone to the US and played the trump card with regards to beating on the issue of transaction. And the DRC obviously has cobalt, lithium, and uranium, all of these key components for the tech companies, something that America wants. So there have been discussions. The Deputy Chief of Staff of the President actually flew about a week ago there and was able to discuss around that. So whether that will come to anything, but what's on the table, Stephen, is that the discussions are there. And bear in mind, there is a railway being built by the US for $2.3 billion from Lobito in Angola all the way to DRC. So this might actually turn out as a reality at the end of the day.
I mean, isn't China quite involved in the DRC? The last American involvement was back to Mobutu Sese Seko.
It was. So this was to actually counter the Belt and Road Initiative. And if you remember, President Joe Biden, before he left, his first and last trip to Africa was to Angola. So it's actually not rocket science. And that railway itself is supposed to move copper. So to add either endowments from DRC won't be difficult. To just be a matter of just agreeing on the commercials. So it'll be interesting to see how that plays out, Stephen.
And then Ghana getting a little closer to nuclear power. They would be I think the third country in Africa?
It's actually, at the moment, it's only South Africa through the Kuberg. Yes.
DRC has one, I think.
And then Egypt is building with the help of the Russians, which is very interesting. That's a very interesting fiasco. And then Ghana has been just given the go-ahead by the International Atomic Energy Agency. Very complicated. Sounds like a nuclear formula. But this project goes back about 3 years ago or 4 years ago. President Nana Akufo-Addo, the former president of Ghana, actually implemented it. And the cost of the investment is about $8 to $10 billion US. And this is actually quite a big chunk, because at the moment, I think the GDP for Ghana is not at its best. But it's going to be quite a significant investment. I think the potential thing here is that nuclear power at the end of the day is probably the future. But there are a lot of restrictions with regards to nuclear power, and it makes sense because of the weaponization that can happen around it. So one of the big things that I've actually found interesting, Stephen, is that you are not allowed to have nuclear power that contributes 10% more than than what is required for your country. There's some sort of a law there. And then the other thing is that it should be less than 1 gigawatt. So basically, at the moment, with Ghana and this project, if they do produce at full optimum supply, it gets to 5.5 gigawatts. So they're kind of saying, okay, we need to build. We don't have the money, but if we do build it, we'll actually have more than we need. So what we do with all this energy? And for me, there's a positive spin there because there's a big challenge with energy and power in Africa. If there was a way to spread that, or maybe spread that love of energy across the continent, that'd be a big thing. But ultimately, a great opportunity for Ghana with regards if this successfully works out, Stephen.
And then TLCom, this is a tech fund. They are getting a lot more money.
So TLCom is a tech fund. Just to give you the trends of VC funding on the continent, it's actually been going down. 5 years ago, Africa was receiving about $6.6 billion through VC funders into tech startups. Last year, it was 3.6 billion. This year, it's now 3.2 billion. And this is across the continent, compared to a USA that's 144 billion per annum. So there's definitely a downward investment. So when investment like this, which is TLCom, which is an African multinational that sources tech funding, is able to secure $70 million, it's a big thing. And one of the key countries they want to focus on in terms of expansion, and they're looking at investing about 20 tech startups, which is great. But one of the countries they want to expand to is Egypt. They're currently in East and West Africa, which is a good thing. But the positive thing here is that they are very focused in terms of the areas they want to grow in. The key attraction areas for tech funding is fintech, e-commerce, and clean tech. There's a big lack in this health tech and the edutech sector, which are the high social impact areas. So hopefully we'll see some of those companies playing in that space once they receive the funding. But at the end of the day, it's always a great story. And also, just to add, this is the same funding that helped Andela, which is connected to Flutterwave, and also Kobo 360. So they've got a reputation and they're seasoned in terms of the tech funding space, Stephen.
And then very quickly, Gulf companies, they're very involved in the Morocco hydrogen projects.
Yeah, so Morocco seems to be attracting the right kind of money. Maybe it's because the World Cup soccer is going to be there in one country, so maybe that's the reason. But $32 billion has been invested by a UAE Middle East company, and it talks again in terms of the nature of investments that the Middle East is throwing into Africa, and it's and their focus obviously in terms of gas and infrastructure around that. But they're not the only players. There's a Spanish company, a Spanish energy company called Cepsa. There's a Abu Dhabi company called Attacq that is all investing in the area of synthetic fuels, synthetic fuels and green steel in the Moroccan space. So there's a lot of opportunity, investment that has been attracted. And Morocco, in a nutshell, says that they will need $760 billion by 2050 for infrastructure just to accommodate the vision. And they are going aggressively in terms of clean energy, green energy, and anything that's related to the green economy. So Morocco is actually on a nice wave at the moment, and they're attracting the money and they're putting it to work. So that's a fantastic thing.
Dr. Rutendo Ndwingi, thanks very much indeed. Founding Director at Tribe Africa Advisory, author of Rumble in the Jungle Reloaded, with an update on what's happening on our continent. Bringing the time on The Money Show to 7:30.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a certified financial planner at Galileo Capital. Warren, good evening. You want to talk tonight about why you should not reduce the risk of your investments when you get older. And I have to say, it had me scratching my head a little bit. I find as I get older, I drive in a much safer way. I live a slightly safer life. I like to take less risk. You're suggesting we shouldn't do that as we get closer to retirement.
Well. I think you should probably drive a bit slower and be a bit safer on the roads. Our reflexes are not as good as when we were younger. So with investments, the difficulty is that we want to manage risk. We want to avoid risk sometimes as we get older, and we would love a bit more certainty. We live in such an uncertain world. Right now, it seems to be on steroids, the uncertainty. But the concern I have is that when you buy certainty with your investments, you could be doing that at an enormous cost. And very often, the temptation to say, I'd like a bit of certainty, I'd like a bit less risk, seems intuitively correct, and certainly on a human level, I understand it. But unfortunately, that uncertainty and potentially the volatility of investments, the rocky road that they give us, could be the very thing that helps get us to a comfortable retirement. And the certainty could be the thing that actually derails us and leads us to a very uncomfortable retirement.
Okay, so there's a difference between risk and volatility. Sometimes these things can look the same. Why are they very different?
So let's talk about volatility, and I know it's jargon, and we try to do our best to avoid that. But when you look at an investment that is nice and stable and predictable, I think the two best examples I can think of would be a fixed deposit at the bank, or an RSA, retail savings bond from government, where you know exactly what you're getting. They're going to guarantee you interest rate of 10% a year for the next 5 years, or whatever it is, 10.5% per year for the next 3 years. And on a human level, that's almost designed for us. That's catnip, and the reason is because it gives us all the certainty we could possibly want. We know that we're going to put our money in 3 or 5 years' time, whatever the term is. We're going to get that money back, and every year we're going to get paid our 10 or 10.5 or whatever percent interest. Everything is known, and we feel great. The problem is that when you look at interest rates and the certainty they provide, and you measure those interest rates that you're going to be earning, the interest that you're going to be paid, and you track it against the cost of living, and you see how the cost of living rises over time, it's no coincidence that cost of living seems to track the interest that we earn on our cash. So if you're earning around 10% on a fixed deposit, guess what? The cost of living is probably doing the same amount of growth against you. In other words, your money is losing value by about the same amount. So the certainty that you're getting from a very stable, very predictable, basically zero volatility investment is locking in absolute certainty that you're not going to be able to beat the rising cost of living. And the simple reason is that you might earn 10%, and that might feel really good to you, especially if the cost of living is only 6 or 7, but you're forgetting that you're going to pay tax on that interest. And so something which has never lost you a cent from one day to the next, if you only store your money in a bank account or a fixed deposit or a money market account, and you look at your buying power of that money in 10 or 20 years' time, unfortunately, the power of your money will have eroded substantially. So that's a zero volatility investment. That's an investment that gives you absolute stability. It's locked in the worst possible outcome for you. If you contrast that with something that we can all access, which would be the South African stock market or the global stock market, and you can do that very simply. You can buy an index tracking, exchange traded fund, or an index tracking unit trust, or just a general equity unit trust and a global equity unit trust. You would be in the stock market. It doesn't take a real genius just to buy it. I mean, there's no specialist knowledge required there. The difficulty with an investment like that is it moves up and down in huge waves. And sometimes, you could look at your statement today and it'll be up, 100,000 if you put in R1 million, and you'd feel, really clever and really happy with life. 3 months later, you look at your investment and it's down 100,000 Rand, and you feel terrible. And that is the definition of volatility. If you had to put that on a piece of paper, it would look like the saw blades, or like a roller coaster. It's just going up and down all the time. And as human beings, that's the one thing we're not programmed for. We don't like that volatility. We don't like the instability of stock markets. We crave certainty. However, you look at the stock market over a 20 or 30-year period, whether it's in South Africa or overseas, and stock markets tend to grow at about 5% a year faster than the cost of living. So you get no stability, you get no certainty every single day, but what you get is enormous protection against the cost of living increases. So on the one hand, go for stability and lock in a certain rate of return on a money market, also locking in the certainty that you're not going to beat the cost of living rises, or embrace volatility, which is what it is, and understand that you're protecting yourself against the real risk, which is the rising cost of living. And unfortunately, you and I are not going to do a show next week to say, listen, Joe Soap, your cost of living has just changed by 0.2% this week. That's not newsworthy. It's not a big event. it happens day after day, week after week, month after month. It's like a slow poison, and no one's shouting at you to alert you to the problem until it's too late. So volatility, I think we need to be comfortable with it, and certainty, we should actually be a little bit more wary than we would have been in the past.
A big part of this, of course, is how old and how long do we think we're funding for? And obviously we find that people are living longer now. If you go for a physical and you're middle-aged, often the first question from the doctor is, are your parents still alive?
And 40 or 50 years ago, a 50-year-old would have answered the doctor and said, no, they're not. They died a while ago. But nowadays, a 50-year-old will very comfortably expect to live for 30 to 40 years. There are, a large number of people in their 80s and a smaller number, but a rapidly increasing number of people who are getting to their 90s. And, people at 21, who are 21 today, they should expect comfortably to live to an age of 100. That would not be unrealistic. And so if you're looking at that and you're saying to yourself, I'm 50 today, I plan to retire when I'm 65, you need to say to yourself, that means that at the age of 50, if I keep reducing the volatility of my investment, so I keep embracing certainty, and I get to the age of 65 and I want no uncertainty. I want everything locked away in fixed deposits or cash or money market accounts because I'm about to retire and I can't afford to lose anything. What you've done is you've limited the buying power of your money for life. In other words, you're not going to get that volatility which is unsettling, but also gives you the inflation protection. So we need to say to ourselves, at age 65, surely we shouldn't be reducing the risk right down. We should be moderating the risk. That's not a bad idea. But that means you don't invest like a 21-year-old. You don't have 100% of your money in shares, cryptocurrencies, and your favorite horse at the horse races. But you should have a very high exposure to the stock markets, and you should aim to retain that exposure for the remainder of your life. It shouldn't be going down, which would have been conventional wisdom, 20 or 30 years ago.
If you have more money, can you then have more volatility?
So this is the great unfairness of life is those of us, there will be lots of us that will get close to retirement and realize we don't quite have enough. We might be forced to take a package from our employer and, at age 65 and realize that, the money's just not going to be enough for our lifetime. And so the temptation then would be to increase the amount of risk we take, increase that volatility, so that we give ourselves the best chance of growing our money a bit faster than we would have done in the past to try and make up for the reduced amount of capital we've got. If we don't have enough, the temptation is, well, let me scale up my risk so that I actually try to make up for lost time and get that capital back, even if I can't afford it. The difficulty with that is when you retire and you don't have enough money, and then the stock market goes down, you're drawing from your investments. And if you've got 75% in shares, which is what a lot of balanced funds have, and balanced funds are the core vehicle for all retirement funds, then you might be in a position where your investment has gone down 25% in a really bad crash, and you're drawing on it, let's say at 5 or 6 or 7% a year, which means you're eroding the value of that money very significantly. You might actually be in a position where you cause a permanent loss of capital to yourself. And so, you need to know that if you're compromised financially as you hit retirement, you actually need to be a little bit more conservative. You can't afford to be drawing on your money and having big stock market moves that force you to sell assets at a huge discount. The other side of that coin is if you've got enough money and maybe you've got a bit of excess and you're going to leave some behind to the next generation, you're in a position where you can afford that volatility because you might not be drawing 6 or 7 or 8% from your capital. You might only be drawing 2.5% a year. And that means you can actually allow your capital to grow and still draw from it without too much concern that you're causing an erosion of capital. So unfortunately, in this kind of a situation, the more money you have, the more risk you can take, which means you give yourself a chance of actually growing your capital even faster faster. Whereas the very people who need that capital growth can't afford to take the risk because they might just be in a position of even more losses in a 2 or 3 year period where markets hurt you.
When you talk about risk and volatility, does that mean you need to think about the overseas market option very carefully too, about where you actually invest? And I can hear your voice in my head, diversify.
I'm brainwashing you, Stephen. So I think it's true. We need to spread the risks of our investments as far and as wide as possible. So risk management for me is proper diversification. It's not avoiding volatility. You need to understand the concept of embracing volatility, but that doesn't mean you take all of your money and you put it into one share, which then might triple your money or take it to zero. That's not embracing volatility. That's just taking the risk through the roof. So if you're looking at the stock market as a place to give you good inflation protection, then the one thing you need to understand is that you don't know which stock market is going to do well over the next 5 or 10 or 15 years. And that means you should embrace having some in South Africa, in the South African stock market, and a significant portion in global stock markets as well. And that means that you'll be exposed to countries where things might be going very well and their stock market's doing particularly well. And equally that you'll be invested in countries where things are going tough for them. And if we look at it where we are right now, who would have thought that the German market would be going well when there's a potential that they'll be dealing with tariffs, and Japan's going well even though they've got an aging population, and so there will be so many factors that will move your money in a direction. But having significant diversification means you don't need to worry too much, provided those eggs are spread across many different baskets. And so I think, again, if you're in a position getting closer to retirement, make sure that your range of overseas investments at the least is probably around that 45% level in international investments, and at the maximum probably closer to 75%. I'm saying probably because all of us are different. All of our positions will be slightly different from one person to the next. But if I look at the numbers and do kind of scenario planning, we should be aiming to have that as a range, 45 to 75% offshore.
We're speaking to Warren Ingram, the Certified Financial Planner at Galileo Capital, and we have a question from Katlego for you, Warren, saying, my employer is forcing me to take life and disability insurance through the company retirement fund. I'm unhappy because I want to buy my own insurance to get more loyalty points. What can I do? Katlego, we'll have an answer for you in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, the Certified Financial Planner at Galileo Capital. Katlego's question for you, Warren. My employer is forcing me to take life and disability insurance through the company retirement fund. I want to buy my own insurance to get more loyalty points. This happens, I think, quite often. You move to a new company and they say you have to do this.
I think Katlego should probably be happy about it, Stephen. If I look at the price of insuring my life on my own, in other words, I go and buy my own insurance from an insurance company, and I do the diligent thing, which is I go and get a bunch of quotes from different companies. I tell them all my information. I negotiate hard. And I look at the premium that I'll pay relative to what I would get from an employer fund for exactly the same rand amount of cover. So let's just say I want to buy 5 million rands worth of insurance. 5 million rands of insurance through an employer fund is way cheaper and by many rands cheaper than doing it in your individual capacity. And the reason for that is the base of people that work at the company. In other words, it's not just me that the insurance company is looking at when they decide to charge a premium. When an insurance company looks at an employer fund, there will be a bunch of people that they will look at from young to old. And the idea there is that, the older people, are perceived to be higher risk and closer to death. The younger people, they might drive mad, they might be a little bit more reckless on the car, but at the same time, they're likely to live a lot longer. And so that spread of age in a pool of people at a company means that insurance company will look at that and say, this is a better subsidized pool of people. There's a nice discrepancy in ages, which means we're not going to be paying out to underwrite a death for every employee in the next 5 years. It's likely to be over long periods of time. So insurance companies will charge you a lot less for an employer fund than they will for an individual person, and that's particularly tricky if you think that there is a chance you might have some kind of a chronic illness in your family history. Obviously not now while you're busy in trying to get the insurance. You need to disclose everything. But if you think that in your family history there might be some kind of severe illness, then being part of an employer fund will help you mitigate those kinds of costs. So I think and that's probably even more true for disability insurance. I think disability is, a very important form of insurance, but it's monumentally expensive when we try and do it, individually. And so getting it through an employer, I think Attacq should be, very grateful that that's being forced on them. And maybe just to jump on my soapbox for a second, I don't think you choose insurance based on loyalty points. I just think you're missing the wood for the trees when you make a decision like that. You choose insurance because the premium is good, they're going to pay out when they need to, and they are treating you fairly. That's really key. Everything else is just icing on the cake. But what you want to know is, if you've lost your life, you want to know that your loved ones are going to be looked after, or if you've lost the ability to earn an income, that you're going to be paid out. Loyalty points is not, that's a distraction. That's not why you buy insurance.
It's not the main thing. For all of these things, it's all about time, right? And that's your biggest ally in this. And that's where you've got to manage the volatility and the risk.
Exactly right. So if you've got a long time to live, I see a lot of articles saying that retirees should be really concerned because they might have a long lifespan. Well, I think that's a terrible way of looking at life. If you've retired at 65 and you've got another 30 years of life, that's a reward. Like that's something you should look forward to. And it's the same when you look at your investments. If you've got a 30 to 50 year investment span, that means you can embrace some volatility. You can allow your money to stay in markets without kind of creating an artificial deadline. If you're 50 and you're saying to yourself, I might live to age 90 or 100, you don't need to worry about 65 as a cutoff period. What you need to say is, I might be investing for 50 years. I can afford the risk and the volatility of markets. What I can't afford is the certainty of cash and money market accounts, which is going to destroy the buying power of my money.
And obviously what you need to do very carefully is you need to just make sure you're also on top of things. So you need to actually make sure that you understand where you are and then not panic about it.
Yeah, and understanding that your investment statements are sometimes going to look a little scary, and any high quality investment, if you've got a spread of cash, bonds, property and shares, you're going to look at your statement somewhere along the line and it's going to be down. And that's okay. If you've got a good spread in South Africa and globally, it's going to go up or down. But over long periods of time, it's going to be very rewarding if you stay invested.
Warren Ingram, thanks very much indeed. Co-founder at Galileo Capital and, of course, a certified financial planner on personal finance this evening.